But here's what they're not telling you. While everyone stares at price charts, a quiet fracture is happening beneath the surface. Paper silver and physical silver. They're no longer the same market. Industrial buyers are panicking. Central banks are repositioning. And the delivery failures, they're starting to pile up. What happens when the world realizes there isn't enough physical metal to back all those paper promises? The answer to that question could rewrite every portfolio, every strategy, every assumption you've made about precious metals. And the clock, it's already ticking. Welcome to Silver Radar. Now, if you've been around long enough to remember when a handshake actually meant something, when people kept their word, and when paper certificates were backed by real assets in a vault somewhere, then you already understand why what I'm about to share matters. Do me a favor, if this kind of straight-talk economic analysis is what you've been searching for, go ahead and hit that subscribe button. Not for me, but because the information coming your way could be the difference between being prepared and being blindsided. And one more thing, drop a comment and let me know, where in the world are you watching this from right now? I want to see how far this message is reaching, because what's coming, it's not isolated to one country, one currency, or one market. This is global, and it's already in motion. The global silver market is breaking, not with headlines or crashes, but quietly, methodically, beneath the surface where most investors never look. Right now, two silver markets exist. One trades on screens, the other moves in armored trucks, and they're no longer speaking the same language. COMEX warehouses, the backbone of futures, pricing, are bleeding inventory. In the last 18 months, registered silver, metal available for delivery, has dropped by nearly 40%. Yet the price, it barely flinched. That disconnect is not normal. It's a warning signal that something fundamental has shifted in the mechanics of this market. Major bullion dealers are now quoting delivery times of 6 to 8 weeks for standard products. 3 years ago, same order, 72 hours. Premiums over spot price have doubled, sometimes tripled, depending on the product. An investor looking at the spot price sees $29 per ounce, but walk into a dealer and you're paying $34, $35, sometimes $38 for physical delivery. That $5 to $9 spread, that's the market screaming that something is broken. The London Bullion Market Association, the LBMA, quietly published a report last quarter. Buried in the footnotes was a single line about delivery stress and logistical challenges. Translation, we're struggling to match paper contracts with actual metal. Futures contracts promise delivery, but what happens when the metal isn't there? Historically, cash settlements. The buyer gets dollars instead of silver. But now, institutional buyers are rejecting cash settlements, demanding physical delivery, and the system is straining. This isn't speculation. This is documented settlement pressure that's never existed at this scale before. The derivatives market operates on a principle called fractional reserve, meaning multiple paper claims exist for every single ounce of physical silver. Industry estimates suggest the ratio could be anywhere from 100 to 1 to as high as 500 to 1. That worked fine when everyone trusted the system, when participants were content to trade contracts without ever taking delivery. But trust is eroding. Walk into any major bullion vault and ask to see their allocation records. What you'll discover is startling. The same ounce of silver can be claimed by multiple parties, each holding a certificate, each believing they own that specific bar. It's not fraud in the traditional sense. It's how the system was designed, efficient, liquid, functional, until it's not. When confidence breaks, when enough participants simultaneously demand physical settlement, the entire pricing mechanism collapses. And we're watching the early stages of that collapse unfold in real time. Registered inventory at COMEX, the silver actually available for delivery, now stands at roughly 45 million ounces. Open interest in futures contracts, over 900 million ounces. Do that math, that's a 20 to 1 ratio at minimum. And that's using the most conservative numbers. This fracture between paper and physical isn't some temporary glitch, it's structural. The financial architecture was built for a world where commodities flowed freely, where supply chains were stable, where geopolitical tensions didn't interfere with market mechanics. That world no longer exists, and silver, sitting at the intersection of monetary uncertainty and industrial necessity, is the canary in the coal mine signaling that the old rules are dying. Major banks that once dominated silver trading are quietly reducing their exposure. JP Morgan, which paid nearly $1 billion in fines for manipulating precious metals markets, has shifted strategy entirely. They're no longer major players in the paper market. Instead, their name appears on vault receipts. They're holding physical, lots of it. When the largest banks transition from trading contracts to stockpiling metal, it tells you everything about where they think this is heading. Meanwhile, retail investors are pulling silver out of exchange-traded funds at accelerating rates. SLV, the largest silver ETF, has seen outflows that don't match the price action. Investors are selling shares, but they're not selling silver. They're converting paper exposure to physical holdings, safety deposit boxes, home safes, private vaults. The metal is moving from institutional custody to individual possession. This behavioral shift reflects something deeper than market sentiment. It reflects a loss of faith in the system's ability to deliver when it matters. And history shows us what happens when that faith disappears. The price doesn't adjust gradually. It gaps. It dislocates. It reprices overnight in a way that leaves everyone who stayed in paper exposure scrambling to understand what just happened. The divergence is accelerating. Every week brings new data points confirming the trend. Higher premiums, longer delays, more settlement disputes, more contract rollovers that should have resulted in delivery but didn't. The fracture isn't coming. It's already here. The only question now is how long the system can maintain the illusion that paper and physical silver are still the same thing before the market forces a reckoning that will shock everyone who wasn't paying attention. Something unusual is happening in corporate boardrooms that most investors will never hear about. Procurement officers at major manufacturing companies are breaking protocol. They're signing contracts that lock in silver supply 2, 3, even 5 years out. And they're paying premiums that would have been unthinkable 18 months ago. Why? Because they've run the numbers, and the numbers are terrifying. Solar panel manufacturers are facing a mathematical nightmare. Each gigawatt of solar capacity requires approximately 32 tons of silver. Global solar installations are projected to exceed 400 gigawatts annually by 2027. That's over 12,000 tons of silver consumed every single year, just for solar. And that's a conservative estimate assuming current technology. New high-efficiency panels actually use more silver, not less. The industry has been desperately searching for alternatives. Copper paste, aluminum composites, experimental alloys. Millions in research funding chasing the same goal: reduce silver content without sacrificing efficiency. The results? Marginal at best. Silver's unique properties, its unmatched electrical conductivity combined with its resistance to oxidation, make it irreplaceable at current technology levels. Every attempt to substitute has resulted in performance degradation that manufacturers cannot accept. Here's what makes this crisis different from typical commodity squeezes. When oil prices spike, consumers drive less. When copper gets expensive, construction slows, demand adjusts. But solar installations aren't driven by market economics anymore. They're driven by government mandates, climate commitments, political promises that cannot be reversed without massive consequences. China has legally bound itself to carbon neutrality targets. The European Union has emission reduction requirements written into law. These aren't suggestions. They're obligations backed by trillions in already deployed capital. Electric vehicle production tells the same story. A conventional gasoline car uses approximately 15 grams of silver. An electric vehicle? Between 25 and 50 grams depending on the model. Tesla alone plans to produce 20 million vehicles annually by 2030. That's 500 to 1,000 tons of silver for one company. Now multiply that across every automaker pivoting to electric. Volkswagen, GM, Ford, BYD, Hyundai. The numbers escalate quickly into territory where available supply becomes a genuine constraint. But the real shock is coming from a sector most precious metal investors completely ignore: data centers. The artificial intelligence boom is driving unprecedented demand for advanced semiconductors. Every AI training cluster, every edge computing facility, every 5G base station requires silver in amounts that dwarf previous technology generations. A single hyperscale data center can consume more silver in its construction than a small city uses in a year. Medical technology represents another non-negotiable demand source. Silver's antimicrobial properties make it essential in wound care, surgical instruments, medical device coatings. Healthcare systems cannot simply stop using silver because the price doubled. Patient safety isn't negotiable. Hospitals will pay whatever the market demands because the alternative is unacceptable. Water purification systems in developing nations rely heavily on silver-based filtration. As populations grow and clean, water becomes scarcer. This demand expands regardless of price. It's humanitarian infrastructure that cannot be compromised for cost considerations. Now layer in the supply side reality. Global silver mine production has been essentially flat for a decade. New discoveries are rare. Existing mines are depleting. The average grade of silver ore is declining, meaning more material must be processed to extract the same amount of metal. And here's the critical point. 70% of silver comes as a byproduct of mining other metals, primarily zinc, lead, and copper. Silver miners don't simply increase production when prices rise. They're constrained by the economics of the primary metal they're actually mining. Recycling was supposed to solve this. The silver industry has promoted recycling as the solution to supply deficits, but the reality is brutal. Current recycling rates hover around 15% of annual consumption. Even with perfect recycling, which is technologically impossible, it wouldn't come close to closing the gap. And much of the silver being consumed in solar panels and electronics is functionally unrecoverable. It's distributed in such small quantities across such large surface areas that extraction is economically unfeasible. The Silver Institute's most recent supply-demand analysis projects a deficit exceeding 200 million ounces annually by 2025. That's not a temporary imbalance. That's structural undersupply in a market where industrial users cannot reduce consumption, and new supply cannot ramp quickly enough to compensate. What happens next is predictable. Industrial users begin hoarding. They build strategic reserves. They lock in multi-year supply contracts. They vertically integrate, buying stakes in mining operations to secure their own supply chains. And when industrial giants start competing for finite physical supply, when their procurement budgets dwarf the entire investment demand for silver, price discovery enters a new regime that historical models cannot predict. Because this isn't speculation driving demand, it's necessity. And necessity doesn't respond to price signals the way speculation does. It simply pays whatever is required to secure supply or production lines shut down. And that's not an option anyone is willing to accept. There's a meeting that takes place every 8 weeks in Basel, Switzerland that most people have never heard of. The Bank for International Settlements, the Central Bank for Central Banks, hosts representatives from the world's most powerful monetary institutions. And in recent gatherings, the conversation has shifted in ways that should terrify anyone holding significant cash positions. The numbers they're discussing aren't public, but the policy responses tell you everything you need to know. The Federal Reserve's balance sheet expanded from $850 billion in 2008 to nearly $9 trillion at its peak. Even after aggressive quantitative tightening, it remains above $7 trillion. That's not stimulus, that's structural dependence. The financial system now requires continuous liquidity injections just to maintain basic functionality. Here's what that actually means in practice. Every dollar created dilutes the value of existing dollars. It's not theoretical, it's mathematical. When the money supply expands faster than productive economic output, purchasing power erodes. And the erosion isn't uniform. Asset prices inflate while wages stagnate. Real estate becomes unaffordable. Grocery bills climb steadily. The official inflation numbers say 3%. Walk through a supermarket and ask anyone if they believe it. Real interest rates are the critical metric most investors ignore. Take the nominal interest rate, subtract actual inflation, and what remains is the real return. Right now, in most developed economies, that number is negative. Savings accounts pay 2 or 3%. Inflation runs at 4 or 5%. The result, anyone holding cash is losing purchasing power at roughly 2% annually, compounded over a decade. That's a 20% wealth destruction simply for the crime of saving money. This creates a phenomenon economists call financial repression. Governments engineer negative real rates deliberately to inflate away debt burdens. It's not conspiracy, it's documented policy. When your debt to GDP ratio exceeds 100% and servicing that debt consumes a quarter of tax revenue, you have limited options. Default, austerity, or inflation. Inflation is politically the easiest choice because voters don't immediately recognize they are being taxed through currency debasement. But something unexpected is happening. The traditional playbook is failing. Central banks assumed they could engineer moderate inflation while maintaining confidence in fiat currencies. Instead, inflation is proving stickier than models predicted, and confidence is eroding faster than anticipated. Gold has been hitting record highs not because of speculation, but because sovereign wealth funds and central banks themselves are diversifying away from dollar-denominated reserves. The BRICS nations, representing over 40% of global population and a quarter of global GDP, are actively constructing alternative payment systems. The M-Bridge project links central banks in China, Thailand, UAE, and Hong Kong in a system that bypasses SWIFT entirely. Russia and China are settling bilateral trade in their own currencies. India is negotiating rupee-based trade agreements with multiple partners. Now, this isn't fringe activity. This is the architecture of a post-dollar world being built in real time. Western central banks are noticing. Quietly, without fanfare, gold purchases by central banks hit 60-year highs last year. But here's what the headlines missed. Silver purchases are accelerating too, not through official channels that require public disclosure, but through sovereign wealth funds and state-owned enterprises that operate with less transparency. When governments start accumulating precious metals while simultaneously inflating their currencies, that's not hedging, that's preparation for a monetary regime change. Pension funds are facing an impossible equation. They need 7% annual returns to meet obligations. Bonds are yielding 3%. Equities are trading at valuations that historically precede decade-long stagnation. Real estate is overextended. Where do fiduciaries turn when traditional 60-40 portfolio construction no longer generates required returns? Increasingly, The answer is alternative assets, including precious metals. The debt spiral is accelerating beyond anyone's ability to control. Global debt now exceeds $300 trillion. That's 300,000 billion. The interest on that debt, at current rates, consumes more than $4 trillion annually. And that's with rates still historically low. What happens if rates rise another 2%? The interest burden becomes unsustainable. Defaults cascade. The financial system seizes. Central banks know this, which is why they're trapped. Raise rates too much, debt crisis, keep rates too low, inflation spiral. There's no path that doesn't involve significant pain. And in that environment, hard assets that exist outside the banking system become the only reliable store of value. Currency debasement isn't coming. It's already here. The question is how fast it accelerates and when the general public realizes what's happening. Because right now, most people still trust that their bank balance represents actual purchasing power. They trust that their retirement accounts will be there when needed. They trust that the system is stable. But the institutions managing that system, the ones with access to the actual data, are positioning themselves very differently. They're accumulating real assets, physical commodities, tangible wealth that doesn't depend on counterparty solvency or government promises. Silver sits at a unique intersection in this monetary chaos. It has gold's monetary properties, but trades at a fraction of the price. It has industrial necessity that makes it indispensable, regardless of monetary policy. And it's scarce enough that when the repricing comes, when faith in paper currencies finally breaks, the revaluation won't be gradual, it will be violent. And anyone still holding purely paper exposure will watch from the sidelines as physical assets reprice to levels that compensate holders for the decade of monetary insanity we've just lived through. There's a classified briefing that circulates among defense contractors and national security advisors that never makes it to financial news networks. It's called a critical minerals assessment, and silver sits near the top of every major power's vulnerability list, not because of its price, because of its location, because of who controls the supply chains, and because of what happens when those supply chains get weaponized. China doesn't just refine 60% of the world's silver. They've systematically positioned themselves at every critical node in the processing chain. Raw ore from Mexico arrives at Chinese smelters. Silver from Peru gets refined in Chinese facilities. Even silver mined in the United States often gets shipped to China for processing because domestic refining capacity was allowed to atrophy over decades. This wasn't accidental. This was strategic industrial policy executed over 30 years, while Western nations financialized their economies and outsourced manufacturing. Now the implications are becoming clear. When tensions escalate between Washington and Beijing, when technology transfers get restricted, when export controls start flying in both directions, silver becomes a pressure point. China could theoretically restrict refined silver exports tomorrow. Not a total ban. That would be too obvious. Just slower processing times, quality control delays, logistical complications. The effect would be the same. Western manufacturers would face supply shortages, while Chinese manufacturers would have guaranteed access. Mexico produces over 23% of global mined silver. Peru adds another 17%. Together, these two nations account for 40% of new supply. Both are navigating complex political environments where resource nationalism is gaining traction. Mexico's current administration has already moved to increase state control over lithium. Constitutional amendments are being debated that would classify other strategic minerals as national patrimony. If silver gets added to that list, if export restrictions get implemented, the supply shock would be immediate and severe. Peru's political instability presents a different risk. Mining operations have faced repeated shutdowns due to protests, environmental disputes, and regional conflicts. Las Bambas, one of the largest copper mines that produces silver as a byproduct, has been blocked more than a dozen times in recent years. Each shutdown removes silver supply from global markets. And as social tensions increase, as indigenous communities demand greater control over resources extracted from their territories, these disruptions are becoming more frequent and longer lasting. The United States imports over 70% of its silver consumption. For a nation that considers itself resource independent in energy, this dependency represents a strategic vulnerability that defense planners are acutely aware of. Silver isn't just in solar panels and electronics. It's in missile guidance systems, radar arrays, satellite communications, military infrastructure that cannot function without it. The Pentagon has been quietly studying domestic silver production capacity. The conclusions aren't encouraging. Even with significant investment, rebuilding domestic supply chains would take a decade minimum. Resource nationalism is spreading beyond silver. Indonesia banned nickel exports to force downstream processing within their borders. The Democratic Republic of Congo is considering similar measures for cobalt. Chile is nationalizing lithium production. Argentina is debating export controls. This isn't coincidence. Commodity-producing nations are recognizing their leverage in a world fragmenting into competing economic blocs. When you control something the world desperately needs, and that resource is geographically concentrated, and geopolitical competition is intensifying, the temptation to weaponize that control becomes overwhelming. The assumption that commodities will always flow freely across borders is dying. Trade fragmentation is accelerating faster than most analysts predicted. Tariffs, sanctions, export bans, investment restrictions, technology transfer controls. Every month brings new barriers to the free movement of goods. Silver is caught directly in this crossfire because it's both a monetary metal and an industrial input. It's subject to financial sanctions and export controls simultaneously. Now, here's the narrative that's quietly destroying investor understanding. The belief that silver will simply follow gold. For decades, this correlation held. Silver moved in gold's shadow with approximately double the volatility. Traders built entire strategies around this relationship, but that correlation is breaking down, and the reason why reveals everything about what's coming next. Gold is purely monetary. Its demand comes from central banks, investors, and jewelry, all discretionary uses that respond to price signals. Silver has dual demand, monetary and industrial demand is inelastic. Solar manufacturers cannot reduce silver consumption because the price doubled. Electronics companies cannot substitute away from silver in high-performance applications. Medical device makers cannot compromise product safety for cost considerations. When monetary debasement accelerates, gold rises as investors flee currency risk. Silver rises too, but for two reasons simultaneously: the monetary bid and the industrial panic. When supply chains fragment, when export restrictions multiply, when manufacturers realize they might lose access to critical inputs, they don't wait for prices to come down. They secure supply at any cost. They build strategic reserves. They lock in multi-year contracts. They vertically integrate into mining operations. This creates a demand dynamic that gold never experiences. Gold investors can wait. Gold jewelry buyers can postpone purchases. Central banks can slow accumulation. But industrial silver users cannot stop. Production lines cannot shut down. Technology deployments cannot pause. Government mandates for renewable energy cannot be reversed. The demand is locked in, growing, and completely indifferent to price. The geopolitical fragmentation amplifies this dynamic exponentially. When China and the United States are cooperating, trade flows smoothly. Manufacturers source from lowest cost suppliers, efficiency rules. But when great powers compete, when supply chain resilience becomes more important than cost optimization, when national security considerations override market economics, everything changes. Companies pay premiums for guaranteed supply. Governments subsidize domestic production regardless of cost. Strategic stockpiling begins. We're watching this transition happen in real time. Not in silver yet, but in semiconductors, rare earths, battery materials, every strategic commodity. Silver's turn is coming because silver sits at the intersection of every major trend reshaping global commerce: the energy transition, monetary instability, geopolitical fragmentation, technology advancement. Each trend independently would drive significant silver demand. Combined, they create conditions for a supply crisis that catches everyone unprepared. The repricing event isn't theoretical anymore. The fracture between paper and physical is documented. The industrial deficit is growing. The monetary debasement is accelerating. The geopolitical weaponization of supply chains is underway. Every precondition is met. The only variable left is timing. And timing, in markets like this, isn't gradual. It's sudden. A supply disruption, a major buyer demanding physical delivery, a geopolitical event that triggers hoarding. Any catalyst could flip the market from orderly to chaotic in days. The question facing every portfolio manager, every business strategist, every policymaker is simple. Are you positioned for a world where silver is scarce, strategically critical, and no longer available at prices that reflect outdated assumptions about supply abundance and market efficiency? Because that world isn't coming. It's already here. The repricing is inevitable, and when it happens, the distinction between paper exposure and physical ownership will be the difference between participating in the revaluation and watching it happen to someone else.